If you visit Vietnam today, chances are you will leave with one overwhelming impression. This place is booming. The skylines of Hanoi and Ho Chi Minh City look like they've been placed on fast forward. The streets are crowded with delivery bikes and construction trucks fighting for space. And if you glance at the stock market, the VN Index looks like a rocket mid-launch. But here's the paradox. While Vietnam's financial markets celebrate like there's no tomorrow, the Vietnamese citizens feel that tomorrow's getting harder than ever. Home prices have raised far beyond local incomes. Small businesses are disappearing almost as quickly as they appear. And beneath the surface, cracks are forming in the very foundation that created Vietnam's economic miracle. In this episode of Econospiracy TV, we are unpacking how Vietnam went from one of the poorest countries in the world to one of the most watched emerging economies, and why that very success might be planting the seeds of a dangerous bubble. Vietnam's current economic journey really begins in the mid-1980s. Back then, the country had just ended a civil war and was struggling with poverty, food shortages, and an economic system that simply wasn't working. So in 1986, Vietnam launched a bold series of reforms known as Noi Moi, essentially opening the doors to private enterprise and global trade. What happened next is often compared to a mini version of China's rise. Factories started moving in, trade volumes exploded. And by the time Vietnam joined the World Trade Organization in 2007, the country had positioned itself as a major manufacturing player. But the turbo boost came from a single corporate giant, Samsung. When Samsung began shifting production to Vietnam in 2008, it didn't just bring jobs, it brought an entire ecosystem. Suppliers, logistic networks, and thousands of skilled workers. Today, Samsung is so intertwined with Vietnam's economy that the two are almost impossible to separate. The next chapter in Vietnam's rise wasn't written in Hanoi or Ho Chi Minh City. It was written in Washington and Beijing. When the US-China trade war erupted in 2018, global manufacturers went into panic mode. Suddenly, they needed a plan B, and that plan B was Vietnam. Companies fled China to avoid tariffs and found Vietnam's mix of low wages, favorable trade agreements, and strategic location almost irresistible. As factories and supply chains relocated, Vietnam's exports soared and foreign capitals flooded in. Even after a brief market downturn, investor confidence bounced back stronger than ever. From the outside, Vietnam looked unstoppable. But on the inside, a very different dynamic was unfolding. In the last few years, Vietnam's stock market has behaved less like a financial institution and more like a festival. Millions of new retail investors have jumped in, often with little experience but plenty of enthusiasm. Brokerages can't open accounts fast enough. Margin debt, which are money borrowed to invest, has hit unprecedented levels. And it's not just the locals. When Vietnam eased restrictions on foreign investors, international funds rushed in, adding even more fuel to the market's rise. The problem is a significant portion of the rally appears detached from economic reality. Companies with weak earnings, questionable fundamentals, or minimal revenue growth have seen the stock prices skyrocketed. Even the country's financial regulator has publicly warned that speculation is getting out of hand, a rare move that shows how worried officials are. If you want to know what a bubble looks like, just check the real estate prices in Vietnam's largest cities. Despite tens of thousands of new housing units being built every year, prices keep climbing. Not because demand from local is rising, but because developers are targeting wealthy buyers, foreign investors, and luxury projects. Local families? They have essentially been priced out. The gap between what people earn and what home costs is no longer just large. It's widening every single year. Banks, meanwhile, have been pouring money into real estate loans, with lending volumes exploding in the first half of the year alone. Smaller developers, under pressure to expand quickly, have turned to corporate bonds and high leverage to finance construction. In other words, classic bubble behavior. While financial markets party, Vietnam's real economy is quietly sounding alarm. Depending on the month, roughly 20,000 businesses are shutting down. Restaurants, small retailers, service providers, you name it. For every vibrant new cafe you see opening in Ho Chi Minh City, there's another around the corner going out of business. This isn't because Vietnamese entrepreneurs lack talent. It's because competition is fierce. Operating costs are rising, and consumers are increasingly cautious. The churn rate is so high that it is starting to overshadow the optimism surrounding Vietnam's economic growth. A booming stock market sitting on top of a struggling small business ecosystem? That's exactly the kind of imbalance that often precedes major corrections. Vietnam's success story comes with one significant vulnerability. It depends heavily on global trade. And right now, the global environment is anything but stable. The United States is tightening rules on imports, demanding stricter environmental standards and cracking down on goods that appear to be rerouted from China through Vietnam. For big exporters, adapting is costly but doable. For smaller firms, it is financially brutal. And here's the uncomfortable truth. Vietnam relies on China for a huge share of its input materials, electronic parts, textiles, machinery. Much of what Vietnam exports to the world begins its life in a Chinese factory. That means Vietnam sits squarely in the crossfire of US-China's tension, whether it wants to be or not. So, is Vietnam in a bubble? Not officially, but the warning signs are flashing. Financial markets rising faster than corporate earnings, housing prices decoupling from local incomes, excessive borrowing of few asset speculation, high business failure rates, heavy reliance on foreign supply chains and external demand. Individually, none of these guarantee a crash. Together, they form a pattern that economists have seen many times before, and it rarely ends quietly. Despite the risk, Vietnam is not an economy built entirely on hype. Industrial output is rising steadily. Tourism and retail are rebounding. Exports remain competitive, and foreign direct investment continues to flow at an impressive rate. International institutions, including the Asian Development Bank, still project that Vietnam will grow at more than 6% annually over the next few years, one of the fastest rates in Asia. So the story isn't doom, it's imbalance. Vietnam has enormous potential. The parts of its economy are overheating, and the gap between financial market and everyday reality is widening. If Vietnam wants sustainable long-term growth, it will need to cool speculative market, redirect capital towards productive industries, expand public investment, and strengthen the financial system's resilience. It must also diversify supply chains and reduce its dependency on China for critical inputs. Vietnam has the tools and talent to accomplish this. The question is whether the country can act before the bubble expands beyond control. Vietnam is one of the most dynamic and promising economies in the world today, but even the brightest growth stories can develop dangerous shadows. The challenge now is distinguishing real economic progress from the illusion created by soaring stock prices and luxury condos. This is Econospiracy TV. If you enjoyed this video, make sure to like, subscribe, and share your thoughts below.